Hey there, welcome to the channel. So today I just want to go through and look at the small caps. I want to see what's going on with the small caps because it looks like they've been underperforming. So just really quick here, we want to go over, this is about 7:30, 10:30 a.m. on the East Coast time. And we can see that the market gapped up a little bit and kind of is putting in this doji right now. So looking at the S&P 500. So that's kind of what we're seeing the action for today. So it's all-time highs, same with the Dow Jones Industrials. And then looking at the QQQ. Now the QQQ is not performing quite as well. So the tech stocks are lagging here a little bit. You can see that it did kind of, I think it had a little gap up, yeah, and then it kind of dark cloud covered over. So that's kind of what we're looking at. And that may play into what's going on with the small caps here. So if I look at the small caps, I'm going to look at the IWM, which is the Russell 2000. Looking at a weekly chart, we can see how this had this outperformance end of last year, and then it's been flat for pretty much this whole year. So if we look here, and I want to draw lines, yeah, so it's been flat really this whole year, okay? So it really hasn't done anything except November. It tried to put this little run in and then failed. And then today it's trying to like break out of a little thing here. So if we look what's going on the daily chart here, we can see that there's essentially, if you look at it, there's kind of this little W here, right? And you kind of have this little, and this is an ugly pattern. This is not really nice, but you can see that the high in this range, and then also there's resistance from this gap here, but this 226 to 228 range is some resistance. Now it's trying to break into it, and which, trying to break out, but right now it's not really having much luck. So right now it's sort of like, we can't say that it's failing, but it's sort of struggling. That's kind of what we see. So now what I want to do is I want to kind of look at it in a bigger picture here, okay? So what I want to do is compare the Russell. So now I'm just looking at the Russell here, which is the green line is the Russell 2000, and the red line is the S&P 500. Okay, so you can see that back here in 2019, the the Russell was ahead of the spiders, and then they all kind of sunk up together with the downturn through the cerveza sickness. And then coming out, what really happened here, they're kind of together. Sometimes S&P outperform, et cetera. But then in November, what really happened, IWM really outperformed. You can see the green line here, it outperformed. But just as we were talking about, it outperformed in this period of time, but then it pretty much just stagflated. It just went stagnant like that. And what happened is the S&P, though, just steady kind of kept going. So that's kind of what we're seeing here. Basically, the IWM right now is underperforming. It really is right now. And so the question as well is, do the small caps lead? Do they lead the large caps? Well, if we look at this chart, and we're trying to look longer term, right? We're trying to get a big picture here. So we're looking at a weekly chart. I mean, do we see that? I don't know. In this period of time back here, well, one thing that seems very apparent to me here is during this downturn here, right? During this downturn period over here, they kind of went together. And then, they went together. So basically, if the market does this kind of thing again, it looks like they kind of move all together. It's just sort of irrelevant. Coming out of here, it's interesting. It looks like the red line, actually, the S&P kind of led the small caps out of the very worst of that. So it's kind of interesting. Now, one of the things is, because I'm looking at a chart, you're not seeing percentages. You're looking more at like relative performance. So, maybe the percentages look this way or that way, but, this is kind of the performance over the longer term, looking at a weekly chart. So here, yeah, it's really hard to say. I mean, you can make an argument in this period here. You have this nice little move in the Russell, and then, half a month later, you see that the S&P has this nice move. And then over here, see, here's the thing. Here, the Russell led. It definitely led during this period of time, right? So it just led, the S&P. But did it really lead it? I don't know. From my perspective, no, it didn't really lead. So if we're looking at it and trying to say, hey, look, the small caps lead the large caps, that's not really the case. It doesn't seem to be the case. And this is one of those things you can kind of look at it. You kind of look at it yourself. It's like a lot of the time, you can go ahead and you can look at different stats and it just sort of pick your stats that want to support your argument, right? If I'm looking at this chart, I can see that it didn't really lead. It's just that the IWM came out and went through a burst and it outperformed during this period of time, clearly outperformed. But then the IWM underperformed this whole period of time here on, it underperformed. So for the whole year, matter of fact, the whole year it's underperforming, right? The green line has gone nowhere. So the point is, if you put money here, you're at the same point you were a year ago. If you put money here, you're ahead, right? So therefore, by definition, it's underperforming. So I just wanted to go over that little thing. And one more item I wanted to look at today was the 10-year. So here we are on a weekly chart of the 10-year yield. So, there's a lot of attention on this. Now, what happened here, like I'm on a weekly chart, so let's just go to a daily chart so we can see. Yesterday, we had this huge move. This is a very significant move. This was like I forget what it was, like a 6 or 7% move on the yields in one day. So it's not totally unprecedented. I mean, we've had some big days before, but I mean, it's a big move. So that's a lot, like a push up on the rates there. Now, the question really would be, will it break out to the 1.7 range here, which also has resistance all the way back here? So really, it's kind of a key sort of thing. Is it going to break out this 1.7? So this is in basis points. So it's 1.7% yield. Today, it kind of looks like it bounced off that area and came back down. Now, we can look at the weekly here. Okay. We're looking at the weekly. Yeah, so weekly in the bigger picture here, you can see how in the Cerveza thingy in March of 2020, you see had this big down in rates. So the rates went down, meaning the price went up. So everyone was running into bonds, out of the market into bonds, put in this W here, right? So we had this thing here, put in this W, and then we, worked our way out of that W. And now we're kind of going higher. Now, really in this one, so now this kind of sets the point here at about 1.7, in that range, 1.75 to 1.8, right? So this is kind of your area of, interest, because this is your big resistance. Your resistance at 2 spots. You have some resistance here, a little lower at 165, but we're pushing into it right now. So what's very interesting here is, if you look at this, it's almost like we have a trend going up here. We also have kind of a wedgie thing going here. So let's see, let me draw it with something else. Let's do this. Let's clear these all. We're going to use something better, I think. Okay, we also have this is kind of wedgy right now. But here's the thing. So it's kind of like a little bit of a wedge. But the thing is, look, it's pushing right now into this. So we have to watch, like, is it going to break out of this resistance here? And then, what's happens is there's immediately more resistance here. So really, okay, so the big picture on the yields is these are moving. It looks like the market is trying to price in the increase in interest rates. And that's something to watch, because this is a huge base over here, right? So this is a huge base, very large base. And if it starts breaking out of 1.7, let's see where it can go from there. Right. You're talking about, breaking out of a range. It's been below 1.7 for almost 2 years now. And if it's going to break out of that, okay, it's going to break out of that, but that's going to be new. It's going to be a little bit of a new situation. So now going out even a little further, you can see the big dip here. Now, of course, it's not like the end of the world, because previously back in 2019, we spent time at rates at 3% on the 10-year. So they were at 3% in this area. Then they went down, had this little run here, and then the Cerveza crash here. But so the point is like, okay, so like it's rates are going to be higher for sure. And back in 2019, our rates were between 3% and 2%, you could say, right? Looking over here, right? 3% and 2%. But so what'll be new though, is if this breaks out, gets above 1.7%, and then the next set of resistance is right over here is at 1.9%. So let's just do this. So here's a resistance area here at 2%. You have your resistance here. Let's just merge these two together around 1.718%. So what's happening is what do we need to know? We need to know that rates are increasing right now. It's making a run at it. We can't predict whether it could, of course, fail hard, like one of the other videos I had where it failed hard and didn't break out. It could fail, but that's what we need to watch, because basically if this thing wants to break out above here and makes a run at this, then those rates are going to go up and we're going to be at 3%. And then economically, you have to look at it and say, well, look, we spent all of 2020 and all of 2021 at rates below 1.7%. And matter of fact, all of 2020, the rates were below 1% at this 10-year. So you have to kind of factor that in. That has to be adjusted into the entire economy, right? So the 10-year is important. The 10-year will affect the rates on cars. Many cars at this point have a 5-year loan. I mean, it used to be 3, but there's a lot of 5-year and a lot of 7-year loans. So that's 10-year. That's kind of putting it in the range, of where it's setting the rate. So this is very important. Now, even homes, a lot of people have 30-year fixed, but the average length people hold homes, a lot of people don't hold them more than 10 years. So it actually affects the interest rates for everything. It's really a huge thing. So what we have to look for and pay attention to is that, look, the rates are going. If they go above here, we just have to see how it's going to affect the rest of the economy. Interest rate sensitive areas such as housing, housing, like I mean, put the interest rates up 1% on housing, and that directly drops, what you can afford by significant amounts, whatever the number is on the house. But, hey, a 1% increase in rates could drop the value of that you could afford a house by, depending in some states, $100,000 or $50,000. That's a lot, right? And that's enough where it's like, look, I can't make the bid, right, to buy the house. And then the sale doesn't go through. And then the price has to come down, that type of thing. And then on cars, it's like the same kind of thing. It's like, well, I'd like to get the fancier car, but I can't, or I have to go used, et cetera, et cetera. So that's something to keep in mind there. Now, at the same time that all this is going on, we just want to look, and I'm watching this one too, right? So we're trying to focus on big picture items in the background that are going on. Now, the dollar. Now, I watched on George Gammon channel, he had that debate between the Alhambra Capital guy and Schiff, and they're debating what the dollar is going to do, But what you can do is, look at it for yourself. UUP is the dollar, it's an ETF tracking the dollar. And also we can look at the US dollar, this one. They're both tracking pretty well the same. But so the big picture here is that the dollar was sinking. So what I want to show here, and we're going to do this. So basically, when you had this discontinuity here, I'll use that fancy word, discontinuity, with the cerveza sickness onset in the US, you basically had the dollar coming down, 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 right? It rose, it spiked up, and then it's almost like, look, everyone ran for cover, right? People are running for cover, makes sense. They're running into the dollar, running into treasuries, all that stuff. It all kind of makes sense, right? But then as it goes on, it's like, okay, starting to pull assets back out, redistribute them normally, let's say. So dollar's coming out, so it's weakening. But now what you really have is this really is a beautiful W, right? I mean, you just have this nice W. And what I want to point out is kind of keep in mind, this isn't an intraday chart. This is a weekly chart. You're looking at 2 years of data. And so just kind of keep that in mind. I know like we look a lot of these charts that we're following on a lot of these, traders on the YouTube and stuff. It's like they're intraday charts, 5-minute, 15-minute charts intraday. And I find it very helpful to look at the really, really big picture. So this is huge. This is a very big, significant bottom in the dollar here. So if you look at it, we've been up. We've confirmed breakout of this W base, and we're on our way up. So if I look at it and say, okay, well, what's going on with the dollar now in the big picture? Like people can debate different things at different times, but we definitely have a rising kind of channel here. There's no doubt the dollar is moving up. Now, when will it stop? So we can never say that, but somewhere in here, where that resistance is, I don't know. But that this previous high was a big high. So, this is kind of would be the initial target area. Whether that will cause the dollar rise to stop, who knows? But it's kind of, you have to be aware of that. So especially if you were participating in things in buying gold or silver or metals, you're in an environment of a rising dollar here. In the big picture, you had a couple days here where a couple weeks, pardon me, where it went down and stuff, but in the big picture, the dollar's going up. So if I look at this chart, all of the things equal, I would say, well, maybe that guy from Alhambra Capital, I forget, Brent Johnson, maybe he's right. Maybe his milkshake theory is happening. I mean, so this is one of those things. If you're looking and listening to all these guys, just look at the chart yourself. Look at the weekly chart of the dollar. I mean, the answer. Now, I would say that for the move in the dollar, it's pretty impressive that gold hasn't. It's pretty impressive that gold hasn't like come off more than it has. It's actually, it looks to me, just looking at the chart, it seems very resilient. So, kind of impressive. But the issue is if the dollar is continuing to push up, and gold is a hedge on the dollar, then that's kind of suspect. All right. Well, I think to summarize here, I've rambled quite a bit. Things that we kind of need to watch, should pay attention to, really are the two big ones. All right, the rates, hey, are rates going to push and break out? Careful of that. That will have consequences. So, if there's a market correction because you read this in the morning, like, oh, rates popped out, and then that's why, right? That's why, because like, oh, it's going to affect everything. The other thing to kind of just note is the Russell, underperforming right now. Small caps underperforming for whatever that's worth, And then the final thing is that the dollar is, in a longer term uptrend. So that's it for this one. Good luck trading. Bye.